Good afternoon, everyone. We'll go ahead and get started. I'm Andrew Cahan. I am one of the financial advisors with the Sides Wealth Advisory Group. Today, we're going to spend some time talking about college planning. We do have a presentation that we'll review, and then we will have time at the end of the presentation for questions. We'll have a Slido open to go ahead and ask questions. And if you feel like your question wasn't answered or you didn't get a chance to type it in, we will also have our general information email box posted so that if you have any questions related to what we covered today that weren't answered, any questions related to anything financial advisory, financial planning, anything like that, you can go ahead and reach out to us directly. Why don't we go ahead and jump into it? First page, thanks so much, Teresa. Folks, I'm sure you've all heard about the rising costs of college tuition, which is probably why you opted into attending today. But just to give some perspective, right now, the estimated annual average for college costs is a little bit over $11,000 a year for a four-year public in-state college. So as an example, here in Pennsylvania, Penn State is considered a four-year public in-state college. If you or one of your loved ones is looking for out-of-state colleges, those costs can range anywhere from 29,000 all the way up to almost $60,000 a year. And then if you are looking at a private college, that can be upwards of $40,000 a year. So those numbers are pretty high. It seems like a really big hill to climb. What I'll tell you is there are tools that we can talk about to help saving. And if it feels like you're getting a late start on it, it's never too late to start saving for college for someone you know, or even for yourself. Every little bit you can do to help prepare helps. Why don't we go ahead and move forward? Today we'll talk about some different tools. We'll talk about 529 plans. We'll talk about Coverdell's, savings bonds, UGMAs, UTMAs, and then we'll talk a little bit about student loans, the different types and the process. Why don't we go ahead and jump into 529s? We can move forward a little bit. Great. So the basics of a 529 plan, you may have already heard of these. A couple of things here. One, every state offers their own individual plan. Anybody can open the account. So you can open the account for anybody else that you know that you have their personal information to go ahead and open. Most commonly, it's parents opening it for their kids or grandparents opening it for their grandkids. But a piece of 529 plans that is unique is that anybody can contribute to it. So a lot of times we'll see a parent or a grandparent open the plan for someone, and then a number of different people contribute to it. So even if it's things like a birthday present, a Christmas present, that's cash, you'll see other family members, other friends actually put that money directly into the 529 contribution. But the person that opens the account is the owner of the account. They control where it's housed, how it's invested, and then ultimately how the money is distributed for education costs. So the child does not own it. Whoever opens it owns it. But a child can have more than one 529 that they are the beneficiary for. So a grandparent can open one for a grandchild, a parent can open one for a grandchild, an aunt and uncle can all open 529s for the same beneficiary, and the child is the beneficiary. We can go ahead and jump forward. As far as contributions to a 529 plan, there are no income limits for the person that is opening or contributing to the plan. So it's not like once that person makes a certain amount of money, they can no longer contribute to it. They can no longer open the account. Anybody can open it. Anybody can contribute to it. There is a maximum amount that can be contributed to the 529 plan, but it is very, very high, and it's normally not something that precludes people from contributing. So for example, every state's different, but in Pennsylvania, the maximum amount that can be contributed to a 529 over the lifetime of the plan is $511,000. So for most people, it's not an issue. I would even go as far to say as there's really no contribution limit. It allows for low monthly contributions. So what that means is you can set up a cycle for even something like, hey, I want to put $25 a month into an account where my child or my grandchild is the beneficiary. And because the investments within the 529 are mutual funds, it makes it very easy to just set up an automatic transfer of 25 or 50 or $100 a month or whatever the number is, and it'll automatically get invested into those mutual funds. One piece that is important is that you can contribute up to $18,000 a year to somebody's account, and you can deduct that $18,000 a year from your federal income tax. It falls under that federal gift tax exclusion. So if you were to contribute more than $18,000 a year, you cannot deduct more than $18,000 from your taxes. But what that also means is if it's a couple that is contributing for their child or their grandchild and they file their taxes together, you can double that amount. So a couple can contribute up to $36,000 a year to somebody's 529 and deduct that from their federal taxes. You can go ahead and jump forward, please. Contributions to your 529 are made with after-tax dollars. So you contribute them, you deduct them from your taxes later, assuming it's under that $18,000. But the growth of those investments are tax-free. So what that means is you put the money in, you don't pay income tax on the growth of those accounts, assuming that the beneficiary uses it for education costs. So most commonly it's for college. It can be used for tuition, room and board, and books are the most common. It can also be used for private school tuition for elementary school and high school. The most common question that we get is, hey, what if the child either doesn't go to college, doesn't use all the money for college, or maybe they receive a scholarship, maybe go to technical school, something like that? What happens to that money then? If that money is not used for education, the beneficiary can take the money out. They will pay taxes on the growth, and they will also pay a 10% penalty on taking the money out because it wasn't used for education. Now there is a little change to that I'm going to get to in a second. But I do hear people that are concerned about that. Hey, I don't want anybody to pay tax penalties if the money isn't used for education. Completely get it. I would just remind folks that even the risk of that 10% penalty may or may not outweigh the benefits that you get from that tax-free growth over time. So everybody's situation is different. You absolutely want to look at it and maybe consult a financial advisor before you decide what you want to do. But in many cases, even that tax-free growth is going to be a bigger benefit than having to pay that penalty, taking it out and not using it for education. Can we jump to the next slide? Because I want to talk about that little bit of change, that risk of that 10% penalty. Just last year, a change was instituted for 529s. So we talked about that money isn't used for education, money gets taken out, pay income taxes on the growth, and then also a 10% penalty. But because of that concern about what if the child doesn't use it for education, rule was just changed to where last year, if the money isn't used to education, you can actually roll that money into a Roth IRA in the beneficiary's name and will not pay income tax on that growth and will not pay that 10% penalty. So that is a major change that has been very beneficial to people, because like that question of, hey, what if I contribute this money to a 529 and the child ends up earning a scholarship, going to a military school, going to a technical college, whatever it may be, and not using that money for education? I don't want to risk having to pay those penalties. You can roll that money into a Roth IRA. Now, of course, there are caveats to that. The total amount that can be rolled from a 529 into a Roth IRA is $35,000. Can only do it in increments that fall into the IRS limits of contributing to a Roth IRA. And that 529 needs to have been open for over 15 years before you can go ahead and do it. I will also remind folks that if you contribute to a 529 and roll the $35,000 into a Roth, there's still more money left. There is also the ability to change the beneficiary on that account. So what that means is, open the account for one child doesn't use all of it for education expenses, can actually change the beneficiary on the 529. So maybe you open it for the oldest child in the family, there's a little bit of money left over, can actually make the beneficiary one of the other children. in the family. As long as they're related, you can actually go ahead and change the beneficiary there. Go ahead and jump to the next slide, please. How do you select a plan that's the right fit for you? I mentioned earlier that every state has kind of their own 529 plan that is managed by a different firm. So if it's important enough to you to get those state tax deductions on the contributions, you can look at whatever firm manages the 529 for your particular state that you live in. You can contribute to 529s that are for different states. You don't get the state tax deduction, but for many people, for the amount that they're contributing to 529, it's kind of negligible for them to contribute to another state's 529 and not have their state's income tax deduction for it. But there are calculators out there that can help you figure out if it's worth it for you to seek out your own state's 529 or if you want to contribute to another state. You do want to consider sorry, can we go back? You do want to consider the investment options that are available for you at those different firms. And I would even say the convenience of where it's housed. Does it make sense for you? It does allow for easy kind of contributions in and process for withdrawing the information out. And is that worth it to you to contribute to a different state's plan? I will also call out that regardless of which state's plan you contribute to, that does not mean the child has to go to college in that state. So just because you contribute to the Pennsylvania or the Maryland plan does not mean that the child has to go to college in Pennsylvania or Maryland. You can use those funds to go to school in any state within the country. We'll go ahead and jump forward, please. You do also have the option of custodial education accounts. What I'll call out here is that you have a lower contribution limit. Actually, can we just jump forward? This will help save a little bit on time. Same thing, earnings are tax deferred. Withdrawals can be tax free, but the owner and the beneficiary of the accounts are different. The limits for contribution, we can go ahead and move forward. The contribution limits for the year are $2,000. So if you are looking to contribute more of that, a Coverdell may not be the right fit for you. Coverdell does allow for a little bit more flexibility in the investment selection, but you're limited in the amount that you can contribute. And there are income limits to being able to contribute to it. Go ahead and jump forward. I want to be sensitive to everybody's time. We can keep going, actually, please. Yep. Perfect. Sorry, if we can go back to the UGMA and UTMAs. Perfect. So there are other options out there, including savings bonds, UGMAs, UTMAs. You may have heard of these. They are treated differently for tax purposes and beneficiary purposes. So we do want to consider them before you're deciding which one to open up. We can jump forward to the next slide, please. Perfect. Thank you. For savings bonds, you may be very familiar with these. These are the types of savings bonds that you purchase from your bank. They have maturity. You may even have some for you or for your child from when they are younger. If the interest in the account is used for, again, qualified expenses, you do not pay taxes on that interest, which can be beneficial. And the definition of qualified expenses for education is a little bit broader. So whereas with 529s, you can use them for tuition, books, room and board at a college. You can even use it for private school tuition. With savings bonds, all of those expenses are considered qualified expenses, but you can even do a few more things like tutoring and a couple other things. So it does allow for a little bit more flexibility in what you use those funds for. But keep in mind that if you're using savings bonds, the growth is just the interest that the bond issuer is willing to give you. Whereas with things like 529s and Coverdells, you can actually invest those assets and hopefully generate a higher return than you would from interest on a savings bond. Can we jump to the next one, please? UGMAs, UTMAs, you may have heard of these before. These existed a little bit before 529s. Similarly, you get favorable tax treatment, but it is a little bit different with these than with 529s. We'll get into that in just a second. What's also different is that the beneficiary actually owns these accounts. So if you remember with 529s, whoever opens the account controls how the money is invested, withdrawing from it and making those contributions. With UGMAs, the beneficiary, whoever is named on the account, actually owns that account. They can make the decisions on how it's invested. They can decide when to withdraw that once they are no longer a minor. There is also a little bit more flexibility in how those funds can be invested, but that impacts the tax treatment. So we talked about 529s, how the investments grow tax free. I mean, you don't pay any taxes as the investments are continuing to grow. What's different with UGMAs and UTMAs is you get favorable tax treatment. And what that means is because it's in the beneficiary's name, as those accounts grow, the beneficiary is actually paying taxes on them. And the reason that's favorable is because, especially when they're a minor, their tax rate is probably a lot lower than yours if you're the parent or the grandparent. So you can open the account for them, they become the owner, but you will be required to file tax returns for them on the interest that is generated. It's probably at a lower rate because if they're a minor, they're probably not earning a whole lot of money. So it's a lower tax rate than you would pay, but there are still tax implications for the growth that they have each year. Can we go ahead and jump forward to student loans, please? There we go. One more, please. All right. Student loans are a major hot topic for everybody. There are a number of different kinds of student loans. You get federal funding, state funding, and then private programs. But before we get into a couple of the differences, I do want to give just some context of outstanding balances and how large student loans are in the country. So we can jump to the next one, please. One more, and then we'll come back to tax credits, please. And I think it's one more, actually. There we go. Thank you. Just to give some context on the amount of outstanding loan balances, for folks under the age of 24, their outstanding balances of $104 billion in student loans. It's a very large number. And for a lot of people, it can be a little kind of overtaking of their income and their financial lives. And what you'll notice is actually in that 35 to 49 age bracket is the highest balance of $634 billion in outstanding loans. What I also think is interesting is that last age group of 62 and older, there's still outstanding loans of $107 billion. Some of that is people taking on loan responsibility for their grandchildren. And some of that is actually their still remaining loan balances from when they went to college. So it's really important to understand what somebody is signing up for when they agree to take out loans either for their own education or for somebody else, because the way the interest accumulates, it can be a very large part of their financial lives for a very long time. Do we mind jumping back to tax consequences, please? All right. The one right after this, please, 19. There are tax credits that somebody can receive while they are going to college. And I just encourage people to look these up if they or someone they know or a family member is approaching going back to school. Is the American Opportunity Tax Credit. Folks, while they're in college, can receive this tax credit for 4 years. And it can be a significant amount of money. So if you have somebody in college or approaching college, please go ahead and do some research on this. But this doesn't just apply for folks that are 18 to 22. There is also the lifetime learning credit. It can be applicable for people going to school at any age. So someone going back to college later in life, or maybe pursuing a higher degree, can still receive tax credits as they're paying tuition. We can go ahead and jump forward a few more slides to the consolidating loan. Right here is good. There is a difference once someone is finished accumulating their loans. There are a couple of solutions out there. They can refinance a number of different loans. They can consolidate. Each one of those solutions has their own pros and cons, and no real solution is right for everybody. So I encourage you to either consult a professional or do some research on your own to find out what is the right fit. The only thing that I would caution you on is that if you were looking to consolidate loans, it could potentially impact um, potential loan forgiveness options later in life. So I would just make sure before you make any decision, before you sign any paperwork, make sure you truly understand what the long-term implications are going to be for potentially refinancing or consolidating your loans. And lastly, if we can go to the next slide, doing cost benefit analysis. I think these are questions that people ask. And what I would say is a number of years ago, we didn't have access to this information. And I'm really happy that we live in an age where we can get access to the information is what is the person going to study before they go to college? What are they expected to earn? And how long will it take them to get to the highest earning peak of their career? And does it make sense for them to take on that student loan balance to pursue that career? It's very hard to quantify that, but we now have access to more information than we ever did before. So I would encourage you before your child goes to school, grandchild, you yourself, is really do some research on what's life going to be like after I finish that study, and is it going to be financially worth it? Now, paying for it, financing it may not be the only consideration when going back and pursuing a higher degree. There is just the pursuit of learning. There is advancing your fulfillment and career that maybe you're not concerned about paying for it. Maybe that's not the most important piece. There could be a happiness factor there, but it still is a factor to consider, because the last thing you want to do is go and pursue a degree or have one of your family members pursue a degree, graduate, go into the job market, and not have the opportunity to make enough money to pay back those loans. So I encourage you to do all that research before you sign up for anything. I'm going to pause right there before we jump to the end slide. If you see on the right hand of your screen is a Slido box, feel free to go ahead and start typing questions in right now. We'll answer them real time. In the meantime, can we jump to the last slide that has our team's information, please? Folks, while you're typing questions, I'll just point this out. This is our group. The thing I really wanted to point out here is on the left-hand side, you'll see an email address that says info@sideswealth.com. If you have a question that we don't get to answer here in the next few minutes, or if you have a question that maybe is not even related to college planning, related to something else, feel free to go ahead and email that box or call our office. We always have somebody monitoring it, so we'll make sure you get the information that you need as quickly as possible. Pause right there. Teresa, do we have any questions coming in?
Not yet.
Thanks. Great question, just came in. It says, if you were saving for your own kids' college, what type of account would you use? I'll preface this with something I start all conversations with, is it truly depends on each person's individual situation. The things to consider are income, the likelihood of using that money for education costs, how much you're going to put away, the tax treatment that you want it to have. So I'd say no one fit is right for anybody, but I'll tell you, if that's a personal question, I have 2 kids of my own, and I use 529s to save for them. Next question, who do I talk to about starting 529 plans and getting funds pulled out of my paycheck? The good news for that is you can talk to me or any of my team members. We can absolutely help you set up a 529 with pretty much little effort. I will just clarify that the money is not pulled directly out of your paycheck, but we can connect it to a bank account to where it can automatically make contributions from a bank account at whatever frequency you want into the 529 plan. So if you do want to talk more about that, feel free to reach out to any of us here on the team, or go directly to call our office or email the info@sideswealth.com. Next question. Thank you so much. Thank you for attending. I did a similar session with you all a couple of years ago, and I really appreciate this refresher. I consult with families in our org and want to always steer them towards starting to save early. Carolyn, thank you so much. I'm glad you do that. It's absolutely important. I'll call out one statistic is families in general tend to spend more time per year planning their vacation than they do planning their financial future. And so I think it's one of those things where everybody kind of knows it's important, but maybe they don't know where to get started. They don't know who to talk to. It's hard to make heads or tails of it. So feel free to reach out to us. We're happy to help you get started. I think everyone here is a participant in one of the 401k plans that we work with. So part of working with 401k plans is we're happy to answer any questions, help you get started, anything like that. So Carolyn, thank you. Thank you for bringing it up, and happy to help wherever we can. Lori said thank you too. Lori, thank you. It looks like that was all the questions. Maybe we'll give it another few seconds to see if anybody has anything that we haven't answered. All right, folks, thank you so much for dialing in. Looks like we finished a little bit ahead of schedule, but that's good. Some of you may have at 12:30 that you need to get to. Here's what I would say. Anything you need from us, we are here to help. You can call our office, you can email us, you can reach out to me directly, you can reach out to any of the team members. We're all here to help. If you are a participant in one of the 401k plans, which I think everything is, when we do our visits, feel free to grab us, ask questions, feel free to call, email, whatever works best for you. I hope you enjoy the rest of your day. Have a great day. I think it's a long weekend for most folks, so enjoy the long weekend, and we're here to help if you need us. Thanks, everyone.